The US 10-year bond yield has touched a high of 2.63%, and this was last seen in March of 2019. So 3-year high. And the dollar index has touched a 2-year high of 99.63. This after 3 Fed governors worried about inflation spoke about a 50 basis rate hike in one go in May. And what is new, they spoke about reducing the Fed's balance sheet at a rapid clip. Now, first, the Federal Reserve Vice Chairman, Lael Brainard, she said that the FOMC will continue tightening monetary policy through a series of interest rate hikes and also by starting to reduce the balance sheet at a rapid pace from the May meeting. Now, that's new. She also added that she expects the balance sheet to shrink considerably faster, more rapidly than during the last runoff, which was in 2017 to 2019, what you call the taper. Again, just yesterday, the San Francisco Fed President Mary Daly spoke at a public meeting and said that inflation at 40-year high is harmful to the economy. The Fed is on its case. She also supported the idea that balance sheet runoff should start in May itself at the Fed meeting. Now, these two statements are also important because both Brainard and Daly are perceived as doves, people who move slowly on rate hikes. The third instance, the Kansas City Fed President Esther George said in an interview to Bloomberg, again over the last 24 hours, that a 50 basis hike is an option in May. She also said that she would want to, alongside, look at the Fed's balance sheet reduction. Both should be dovetailed, was the long and short of her interview. Now, first, therefore, let's look at the balance sheet itself, the details of the balance sheet. Its total size at the moment is $8.98 trillion. And to give you a perspective, it was less than half, $4 trillion just 2 years ago in March 2020. And during the global financial crisis, it was $0.4 trillion, just 400 billion. Look how much it has grown since 2008. Now, some of the treasuries will, they are partly in treasuries, that is US government bonds. 5.7 trillion are in US government bonds and 5.7 trillion are in mortgage-backed securities. Let us look at their maturity pattern. The treasuries, US government treasuries, about 1.67 will mature anyway within a year, and about 2.2 trillion will mature between 1 and 5 years. In the Fed language, they run off the balance sheet automatically. But the mortgage-backed securities are typically long-term bonds. They don't mature so quickly. Hardly a few million are going to mature within 1 year. A bulk, some of them will mature 2 billion, 64 billion in 5 years. But the bulk are going to mature after 10 years. So now let us look at Brainard's statement again. She said she wants the balance sheet to shrink faster than in 2017-19 tapering period. At that time, the Fed had allowed only 50 billion of US treasuries to run off every month. That is, when it matures, they didn't buy it back. Now, that will be too small to make a difference now, because 50 billion a month would mean just 600 billion in a year. If many in the market are expecting the Fed to reduce at $80 to $100 billion a month, which is about 1.2 trillion in the year. But the bigger problem will be with mortgage-backed securities, because they are not going to mature on their own, and the Fed will therefore have to actively sell them in the market, and that can push up home loan rates even further, and that could lead to a further slowdown of the economy.